FTSE JSE All-Share Index has managed an annualised return of 11.4% over the last 5 years. The South African Hedge Fund Index, according to Symmetry, has delivered an annualised return of 10.2% over the same period. Within the Hedge Fund Index, it has been the fixed income component that has delivered the highest returns, with an annualised return of 15.2%. Stephen Brierley of Symmetry joins us in Cape Town to make the case for hedge funds. Before we get there, Warren, some context from you, sir.
Yes, that's right, Bronwyn. Just to give you a bit of a leader into the hedge fund industry, and there are two surveys that have done of the hedge fund industry that I know of. The first one's Symmetry, the other one's Noveri. But just to use Symmetry, seeing as we've got Stephen on the show tonight, just a quick breakdown of the 4 different sectors that comprise the hedge fund universe. The long-short equity, which is the biggest sector on its own, has 19 funds and about 9 billion rand in assets under management. That's without gearing. And then we have the market neutral, which is the sector that tries not to take directional bets on the market. So they do relative value trades like, for instance, buying Anglo Gold and shorting Harmony. And then we've got the fixed income space, which has been quite well. As we mentioned, it's done very well over the last 5 years with 12 funds. And then single manager multi-strategy. This is where funds use a variety of different strategies within one portfolio to try and generate returns. If we just go to the next slide, we'll see that we can just see some of the performance. I've broken it up here from the survey. Long-short equity best performing was 19.2% per annum. And then if we go to the fixed income, this was quite interesting, 22.1%. That was one specific fund that generated that return. And you can just get a feel here. You can see how much risk is taken off the table with the market neutral funds, where the best performance was 13.3 and the median was 9.5. If we just go to the last graph, this is just to show the top funds in each of those sectors over 5 years. Coronation Presidio Fund, we all might know the name of Gavin Jabet at Coronation. He runs that hedge fund for them as well in the long-short space. Mansi Capital is the top performing fund in market neutral. And then we've had Kevin Pretorius on the show before from CAD Capital. And then Brait is the leader in the multi-strategy fund. So from that perspective, Bronwyn, I think the first question for Stephen is, what's he expecting from the fund managers, the hedge fund managers this year?
Stephen, put it squarely in your court there. What are you expecting from the hedge fund managers in terms of performance this year?
I mean, it depends quite strongly on how the markets run and what the markets do. You know, we expect from our managers to be more aware of stock picks than the direction of the market. But certainly the guys, the long-short equity managers who are taking on some net direction would obviously get some sort of beta from the market. So it would depend on how the market is doing. Whereas your market neutral guys, who've had a bit of a tough run lately because you know, being a pairs trading strategy, they're having to look at the correlation between the different shares, and this has obviously been quite problematic. So this is a little bit more of a challenging market. But to answer your question directly, you know, a lot of the managers target you know, the long-short equity space, cash plus 5 to cash plus 7. And if you look back through the history at the guys that have been around for a long time, they've been delivering consistently that. Obviously, last year was a really good market for these managers, you know, because they being short the retailers, or long the retailers, sorry, and short some of the miners, they did really well. But we would like to look for managers who are doing kind of cash plus 5 to 7 in the long-short equity space, and probably cash plus 3 in the market neutral space.
Stephen, I just wanted to come in here. Obviously, we've mentioned those 4 different sectors within the index, or within the universe, sorry. I just wanted to get a sense of which ones are the most uncorrelated to the sort of long-only equity funds that many investors are familiar with.
It would obviously be the market neutral guys because they're taking less net exposure to the market. And then the fixed income guys, because they're obviously trading in bond and cash and credit, kind of credit derivatives. But you know, a lot of the long-short equity managers also they might take some offshore exposure. They might trade in some bonds or derivatives. So it certainly depends on the instruments within the portfolio to kind of give you the correlation to the equity markets. And the multi-strategy guys obviously look for low correlations because they're trading a blend of equity, fixed income, cash instruments, maybe some property, etc., etc. So You really have to look at it per manager to see what sort of instruments he's holding in his portfolio.
Now, it's obviously quite a big thing because the leverage is a double-edged sword, and we've run through some of the performance figures there. Certainly, fixed income, I know the CAD Capital guys doing a really good job with that performance. But just how much does leverage affect the performance figures we've seen in your survey?
Certainly, I mean, the names you've mentioned, like Gavin from Coronation and Muzzy Vizzy on the long-short equity side, they don't take a hell of a lot of gearing. Maybe 100 to 150%, which is 1.5 times leverage on the portfolio. The market neutral guys take a lot more leverage, up to about 250, 300 times or 3 times leverage, because obviously they're taking such small positions between the pairs. They need to leverage up that little bit of return they're getting from those pairs. So they would take maybe 2.5, 3 times gearing. On the fixed income guys, they might take as much as 10 times gearing, but the risk is less so because the fixed income market is an extremely liquid market, and you can trade either side of the portfolio, being long or short, quite easily and get out of those positions. So gearing, the biggest risk to gearing is, can you actually, once you get up, can you get out of that position with sufficient liquidity when markets do turn around? And you could obviously get a nasty surprise if you don't.
I think just in terms of estimating that leverage, it's obviously one characteristic of your job that sets you apart from conventional fund of fund managers. I wanted to ask you, what are some of the other things you need to look at to satisfy yourself as a investor in hedge funds that the investment manager and the structure and the setup is correct in terms of the risk parameters they have? They can control the risk that they're using, and you can sleep at night.
Well, as you know, our process that we follow is obviously very much governed towards operational due diligence. A lot of the fund of hedge fund players now have specialist operational due diligence processes and teams. So you can look at the corporate governance of the businesses and whether they have proper controls in place to actually risk monitor those sort of limits. But it's interesting that people see hedge funds as rather risky, but what they don't see is in the mandates of the underlying hedge fund managers, these managers actually have restrictions on the limits they can take in their portfolios, i.e. in terms of the net exposure they can take, or the gross exposure, i.e. the leverage, or the actual size of the stock positions they can take. So those mandates are very much governed, and they're signed off by the operational teams. And also there's pretty good corporate governance by within the hedge fund industry in terms of the risk analysis that is done by external parties and by prime brokers, which actually gets reported to the fund of hedge fund managers. So there's a daily routine which we follow, and a daily process of reporting to the investor, being ourselves, from the hedge fund managers, to say we are actually mandate compliant and these are the limits we're operating within. And if there's any sort of breach, we see it that day and are able to report to our compliance officers and get to the
Stephen, do you feel that the overall perception of the hedge fund industry has fundamentally changed for the better? I mean, you mentioned that it's traditionally seen as risky, but do you think there has been that mindset change?
Yeah, we think so. With the integration of hedge funds into pension funds under Reg 28, obviously that increased allocation. There's no doubt that Treasury and the FSB wouldn't have made that change unless they were satisfied that there was a proper corporate governance and mandate control within the hedge fund space. And that has taken place over time, and the prime brokers have played a big part in that. Investec, RMB, Peregrine, Absa Capital now have come into the prime broker market, and I don't think those big corporations would have come into the hedge fund framework unless they were confident that it was an industry that was actually going to survive and was sustainable.
Stephen, I just wanted to talk about that. You touched on Regulation 28, which obviously governs the running of pension funds and specifically how much money they can allocate to different types of investment classes. That's been upped. So far as I can tell, looking at your last survey that you produced, which was the January survey, we haven't seen an incredible amount of increase in assets. Can you tell us what's going on from the institutional side around the use of hedge funds at this point?
Yeah. I think obviously it's a long-term education game, and that education certainly hasn't hasn't come through strongly enough. In terms of why we haven't seen a huge inflow into pension funds, I think there's also uncertainty around the tax framework which hedge funds will be faced with, and that's obviously being addressed within another regulatory framework under SISCA rules. And I think obviously once that gets ironed out, even the pension funds will feel a little bit more at ease that that maybe National Treasury and the FSB have regulated hedge funds across the whole investable universe, and not just for the pension funds.
You've touched on obviously this move, and then we'd like to just remind our audience that hedge funds are not regulated or not registered collective investment schemes as yet, but there are moves to bring them into the mainstream in some form. Can you just give us an update on where that process is at the moment?
Sure. We actually had some feedback from one of the individuals in the hedge fund industry last week at a conference, just talking about where he was or where we were with SISCA and with the Treasury and the FSB. Basically what's happening is the framework that has been proposed is to have two different categories of hedge funds under SISCA. The one would be your normal hedge funds as they are now, but they would only be available to very sophisticated investors. How they're going to classify sophisticated investors into hedge funds hasn't been decided yet, but that'll obviously come to light at a later stage. So they would be able to invest in hedge funds as they are managed now, as they are mandated now. So they would be able to take certain levels of gearing, etc. But there will be a more retail-focused class of hedge funds as well, which will have limits restricted on them in terms of their gross exposures, in terms of their reporting, daily pricing, their liquidity, and that will be basically available to retail investors or your man on the street who isn't as sophisticated, isn't aware of the risks that are involved in hedge funds. So where they're at with that, it's still some way to go, but at least that broad framework has been put out to distinguish the two different classes of hedge funds, which will actually be proposed under SISCA.
Stephen, we've got I'm sure a few people in our audience that might be interested in hedge funds now. What do you suggest the course should be for people who are interested? What type of retail investors should be considering hedge funds, and how should they go about doing that? And I think that might be a punt to use a fund-to-fund manager, but nonetheless, I'd like to hear your answer.
Certainly, one of the risks, or one of the things we are certainly worried about as hedge fund managers is retail investors going directly to single strategy managers, because they obviously might not understand the risks of these managers and the risks of putting them in their portfolios with other more traditional assets. So we would obviously suggest a retail investor who has a relationship with a fund-to-fund manager or a big institution such as Old Mutual or Symmetry approach those hedge fund managers and actually work through what he's trying to achieve, why he wants to add hedge funds into his portfolios, and how those hedge funds react with his more traditional long-only or absolute return portfolios. And at Symmetry and institutions like that, we actually have done that research for the investors to say, this is how we believe it'll all work together, and these are the risks, these are the return profiles we're looking at. So, we recommend that clients do that and approach with the professionals rather than actually going directly into the single strategy managers at the moment. Because obviously there's not a lot of education, there's not a lot of data out there for a retail investor for him to do his own sort of research and portfolio optimization.